Actually, my base case for next year is that we're going to hit new lows. So the 3550, 3600 area we have seen this year, it's going to be bridged on the downside. I expect the S&P to ultimately bottom anywhere between 3300 and 3400.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with bond expert Alf Peccatiello. If you haven't yet watched part 1 of this discussion with Alf, in which he explains what the bond market is currently telling us about inflation and the impact of today's higher interest rates, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Alf has also kindly shared several of the assets that he thinks will weather the coming storm best, so be sure to stick around to hear those. All right, let's get started watching part 2 of our interview with Alf Peccatiello. I want to now shift to your financial market outlook, because we just saw a massive rally last week, right? As the market got whiff of, hey, CPI may be coming down a little bit faster than we thought it was going to. The market had its own interpretation of that, which we can, I think we can state is probably different than what Jerome Powell would have liked the message of the market to get. But real quick, we had one of the best best 2-day streaks ever for the 60/40 portfolio in market history. And the Goldman Sachs Unprofitable Tech Index rallied 25% in 2 days, right? So I guess first question for you, Alf, is this massive surge that we saw, if this is a rally that's going on here, is this merited, and do you think it has legs?
The bear market rally, like the one we saw in July, when people told me that there was a new bull market because the Nasdaq had rallied 20% from the lows. Between 2000 and 2001, the Nasdaq rallied 7 times or more, 20% or more for the lows. So there were basically 7 bull market attempts within the bear market. Those are very vicious bear market rallies, but the market only bottomed in 2002. So a full calendar year later, we are trading a very similar environment here, where at any hint that inflation is slowing down, the market is going to try and test the Federal Reserve. It's going to basically go knocking at the door. It's a recency bias. The markets are used to be bailed out by the Fed for 10 years, Adam. So at any circumstance where there is a remote possibility that that happens again, they're going to go and knock the door of the Fed, which means lower bond yields, higher equity prices, lower credit spreads, lower dollar. Everything the Fed doesn't want to see, basically, during an inflation fight. They're going to go and basically test the Fed. And the Fed has already answered partially by saying, guys, it's one print, don't get excited. We cannot loosen financial conditions. So basically, you are trading against the Fed. Can the bear market rally extend? Yes, of course, it can. We are going towards year end. There are technical reasons for year-end kind of rallies. We have seen them in the past. They could extend further. What is the risk reward here in chasing this rally higher? To be honest, the S&P above 4,000 is a bit in the thin air space, I meant. It becomes basically looking at earnings on a downward trend. If you expect earnings to be flat or drop next year, you're basically looking to buy the S&P at a valuation of 18 times earnings. Buying the S&P at 18 times earnings, looking into a growth slowdown with a very tight Federal Reserve, it's not particularly a good idea from a risk management perspective, I would say. Actually, my base case for next year is that we're going to hit new lows. So the 3550, 3600 area we have seen this year, it's going to be bridged on the downside. I expect the S&P to ultimately bottom anywhere between 3300 and 3400. But it's going to be a second leg of the bear market, Adam. It's a slow grind down that is driven by earnings surprises on the downside. Rather than valuations, it's going to be driven by earnings disappointment. It's going to be very similar to Q4, where Amazon drops earnings very aggressively and the market punishes Amazon. And then next year is going to be a much more widespread phenomenon, very similar to 2001, where it was not about deflating the dot-com bubble. That was basically already deflated. It was about real pain in real economy businesses whose earnings were going down, whose labor needed to be cut. And that's the kind of second leg of bear market we're looking at into 2023.
All right. And we're already seeing that, right? I mean, I've had headlines on this channel from everything from the CEOs of FedEx and Maersk. So just big, massive global shippers who are saying, yeah, we're just seeing volumes just drop off a cliff here, right? So these are the guys that see the blood vessels in the circulatory system of the real economy, of real things going from point A to point B, saying, yeah, these things are really slowing down hard. There was an article in Bloomberg last week that like 37% of small businesses were not able to pay their rent in full the other month. So again, your point about kind of the real economy, we're not just seeing it in the tech high flyers who live in fantasy tech land. We're seeing it in the real bricks and mortar part of the world.
Yes, absolutely. I mean, this is already visible in many large companies giving outlooks that are not the most rosy out there. Effectively, we have heard it already from companies that are very exposed to the business cycle or very leveraged, that they are facing already problems. FedEx is a great example, Maersk as well. I mean, those are companies involved in global trades. So they're telling you that the world is slowing down effectively.
All right. Well, look, we've got just a couple minutes left here, Alf. So two quick questions for you. One is, so given this market environment, are there any key trade ideas that you have or investing ideas that you have? I did peek at your most recent newsletter. I saw SOFR call spreads and some potential home builder shorts. Are those still ones you're interested in right now?
Yes. So the SOFR call spread sounds very complicated. It really is a trade to be long bonds. So basically what we're saying is the Federal Reserve can try and pin yields high, and they will, but it's already also priced in the markets. I mean, terminal rates are already priced at 5% for the full 2023. I think actually at some point they're going to be forced to cut rates anywhere next year, probably the second half of next year. So if you buy bonds today, you're buying something that is not pricing that outcome yet. And effectively, you are betting on Fed funds rate being lower than 4.5% in 2024, which I think is a very likely outcome as the economy slows down very aggressively. It's becoming more attractive, I think, at this point to start buying some bonds. They are yielding levels that we haven't seen in a while, and most of the pain in higher Fed funds is already reflected in there. And the other is on home builders. I mean, we talked about the housing market. It really looks bad, to be honest, Adam, to me. And home builders have rallied 18% from their lows in this, very vicious bear market rally. Those kind of bear market rallies in home builders, in real estate related assets, give a very good opportunity to enter shorts there. So you can buy some puts maybe that expire later next year. Or if you have this exposure in your portfolio, you can think of cutting it and using these bear market bounces to basically reduce your exposure to real estate, because it's a sector that will undoubtedly suffer next year.
All right, great. Well, thanks so much. That's the whole reason why we do these things, Alf, is to try to give the average investor, some sort of ideas on how they can navigate what's going on here. You gave us two great ideas right there. All right. Well, look, love to have you back on again in the relatively near future as a lot of what you've laid out here begins to unfold in real time. Alf, as we wrap up here, you have some big news, right? You have been writing one of the most successful free Substack macro newsletters, and you've just launched a premium offering. Do you want to tell us about it?
Yes, definitely. And thanks for the chance, Adam. So the story is that I've had the luxury to be in institutional money management businesses for years. And what I realized there is that basically these institutional investors have access to data and knowledge that is really reserved for these ivory tower members. I was one of them until last year. I then decided to take a leap of faith and to leave the industry and start sharing the knowledge with people through the Macro Compass. And it was a great experience. It became the biggest macro newsletter out there. But at some point, I also realized, Adam, that the newsletter, unfortunately, it's not enough really to bridge the gap between Wall Street and the regular investor in this journey that I want to give people that actually is educational. It gives them interactive macro tools, courses, actionable trade ideas, actionable portfolios. A newsletter is not enough. Therefore, I decided to graduate the Macro Compass from a newsletter to a full macro platform that hopefully will allow investors to step up their macro game. And I'm therefore offering premium content there, premium knowledge, educational kind of content, trade ideas, ETF portfolio, courses, interactive tools that people can use to learn how to look at markets like the pros do. And all of that is available on themacrocompass.com, which is the website of the new macro platform. There are products for retail, more sophisticated retail investors, professional investors, as I've been in their seat too. And the service starts in January next year, 1st of January next year. But if people would like to subscribe now, they get a 10% off if they use the code ALF at checkout.
All right, great. We'll put the macrocompass.com URL up there on the screen. You also share, in addition to everything you mentioned, you're also sharing trading models, right? I mean, people are getting actual Excel models from you out of this, right?
Yeah, that's correct. So they'll get actually actionable trade ideas when it comes to really what to trade, what is the best risk reward. If you're not an active trader, you'll get a model ETF portfolio for a longer term asset allocation to help you navigate your macro risks without having to be too much active. But what I'm the most proud about is the educational content and the interactive tools, Adam, because people will finally get access to this data that is generally reserved only for institutional investors. And I'm trying to make it interactive so people can play around and test their own ideas and check their own macro indicators and check the bond market exactly like I do, which unfortunately is only reserved to professional investors with very expensive access to Bloomberg and other platforms. And I find it extremely unfair. So I'm trying to build tools that allow investors at home to have a similar experience to a pro, which means they will get their hands dirty and learn how to look at these indicators like the pros do.
Well, I love the mission behind what you're doing. It's very complementary to what we're trying to do here at Wealthion too, which is to sort of democratize financial literacy and financial opportunity for folks. And the playing field is, as you and I know, because we've worked in the professional space, is so incredibly slanted towards the interest of the professional insiders. That we're hopefully just tipping it at least a few degrees more, back towards the favor of the average person here who's been so, so disadvantaged to date. So best of luck with that, Alf. Real quick, you're also super active on Twitter. Just give folks your Twitter handle in case they want to start following you there.
Yeah, the Twitter handle is @macroalf.
Fantastic. All right, Alf, I know you got to go. Thanks so much. Wonderful discussion. Look forward to having you back on again soon.
A pleasure as always. Talk to you soon.
All right, well, now is the time on the program where we bring in the lead partners from New Harbor Financial, one of the financial advisory firms endorsed by Wealthion, both to react to the context of what Alf said, but also to talk about what the markets have done over the past week. I'm joined, as usual, by lead partners Mike Preston and John Loder. Why don't we just jump right into it? I guess first, Mike, any particular reaction to what Alf had to say?
Not really, nothing other than I agreed with most of it. Like usual, you tend to bring on guests that are contrarians, at least by some nature, and I think that's a good thing. There's a lot of good reasons to be a contrarian and to be skeptical of the insane money printing we've seen throughout all these years. And Alf's message was basically that we're in a slowdown. There's a slowdown in hiring, there's a slowdown in retail sales. Target just warned, Target retail stores just warned, and that stock is down. The numbers look soft. And he also calls for the numbers in earnings to come down 15% or so, and likewise the S&P to come down by an approximate amount equal to that. I think he said 15% decline in 2023 is what he expects. I wouldn't be that surprised to see it be down a lot more than that, actually, Adam. And, there's a number of different messages in there that we agree with. Like, for instance, he thinks that the Fed is going to be patient, that they're not going to pivot. Everyone's talking about a pivot. Everyone's trying to call the turn in this market. We think that right now we're in another bear market rally. We just hit 4,000 on the S&P yesterday. We're slightly below that now, but the S&P is maybe 18% off its all-time high. The Dow's like approximately 8% or so off its all-time high. We're within just shouting distance of the all-time high of the most overvalued market ever. And still here today, we're at or above the most extreme levels we've seen before, namely the 2000 tech bubble peak in terms of measurable valuation metrics like stock market cap to GDP and many others. And Alf says prepare now. Disaster hasn't hit yet. And so therefore the Fed is not going to pivot until disaster hits. There has not really been any disaster. The stock market is not down much. The housing market is not down much. Outside of the crypto space, where there are some high profile bad news right now, there hasn't been any widespread panic or disaster. And until that happens, the Fed's not going to pivot. And the Fed put in this market is probably a lot lower than where it is today. So, Our message is the same. It sounds a little boring because it tends to be similar week after week until we see something different. We think valuations are pretty insane here. The market is risky, and we would be using strength to rebalance your portfolio and reduce risk overall. So I'll pause there. There's much more to talk about.
Okay, good summary, Mike. And you mentioned a number of things I want to quickly comment on. One, you said I bring on contrarians, and I understand the sentiment. I don't seek out contrarians to bring them on the program, just to make it clear for folks. I try to bring on analysts that have a track record of being very data dependent in terms of how they, build their forecasts and conduct their analysis. I think the fact that so many of them right now are, skeptical of the markets and concerned for the future, both of the economy and that the bear market may resume at some point, just speaks to the degree of precariousness with which we find the markets in the economy in right now. Much more comment on that than on my particular selection criteria for folks. Looks like
absolutely, absolutely. I didn't mean to make it think like you filter for or seek out those types of people. I just think that a real intelligent and diligent analyst these days can't help but be somewhat of a contrarian, because the data is so clear, the numbers are so extreme that you almost just have to have almost blind faith in the Fed and almost kind of magic finance to not think some bit of skepticism. So I'm glad that you've got a lot of these great guests, every single one of them, and there are a number of contrarian views. And I know from time to time there's different views. So we're happy to be part of that. Thanks.
Yeah, and well, no, I'm glad you mentioned it, and I do get comments from time to time of, hey, great, we've heard a lot of the bearish case. Can you bring some bulls on the program? I am trying. Just to let you know, folks. Like, one, they're kind of hard to track down, and when you do, when I do, at least so far, my track record is not good in being able to persuade them to come on the program. And I'm not going to pretend to know exactly why not. And some of these people are in very high demand. They're the people you see on CNBC and whatnot. But I think part of it as well is there may be, because of that magical thinking, comment you just made there, Mike. I'm not certain that they're excited to come on, a venue like this, which is very long form and really trying to dig into, the data and the underlying rationale under their assumptions. I don't think it's a format some of them feel comfortable in. We'll put it that way. It's not going to keep me from continuing to try to get them on the program, folks. But just want to let you know, we do try to solicit that side of the argument. We're just not getting a lot of takers in the near term. All right, a couple other things you mentioned. You mentioned that we are, again, not that far from all-time highs. A lot of people would argue that, hey, being down 18% for the year, Mike, still hurts a lot. It certainly does. But the fact that there's been a fair amount of recovery already, and certainly in the Dow, as you mentioned. But Alf had said that he thinks, based on his models, that S&P above 4,000 is thin air. Right? He's like, I just don't see it going a lot higher than that. And that probably, like you said, Mike, it's a good opportunity to lighten up on positions, especially if they've recovered a bit, and to take some off the table. Also, we've talked a lot about in very recent podcasts, like our most recent Ask Anything Q&A we did the other week, that even though we can come up with a very long laundry list of reasons why the market should roll over from here, there are a number of factors that may conspire to rally the market or keep it elevated into year end. And one of them obviously is just the standard Santa Claus rally that we tend to have in markets most years. But there is a couple factors I'm going to rattle off here just to make sure folks are aware of them. One, companies are out of the buyback blackout period. So buybacks are beginning to become a factor, propping stocks up again here. You do have some forced buying by computer trading algorithms going into the end of the year as funds either do window dressing or they have some mandated buying they have to do or reallocating they have to do. Also, because we've recovered the way that we have, we've broken through on the upside through some support levels, and that triggers computer buying by itself, right? So there may be some of that feeding element on it. But then you also just have the potential, I'm not saying it's going to happen, but you've got the potential for good news on a couple of important fronts. One of them is being China. And we have had some headlines come out recently that they are beginning to loosen their grip in terms of their lockdown of the economy. And so folks are expecting, if indeed China really does start opening back up, that there may be a surge of demand in the global economy. And then also, the headlines change every day, but there could be some developments at some point towards a negotiated peace between Russia and Ukraine, and that would probably be bullish for the markets, at least for some period of time. So I just want to, put it back on the table here. And John, I'd love to get any comments you have in reaction to that. But it's just, there's a lot of things the market should do, and maybe in the long run it will, but it can do a lot of things we don't think it should do in the short term. And, bucking some of these downward trends that Mike just mentioned, I just listed a whole bunch of reasons why we could see a rise, or at least hanging out at these levels into the rest of the year. The last thing I'll mention, then I'll let you speak, John, is I just interviewed Jim Rogers last night. It's always super interesting and entertaining interviewing him. That's going to come out next week, the week of Thanksgiving. But Jim coined this current rally as the last rally before we get, in his mind, the worst bear market of his lifetime, joined by the worst recession of his lifetime. And I'll let him go into details in that interview next week. But it stuck in my mind that he said, hey, everybody, this is the last rally. This is your last chance to kind of get out, as close to whole as you can. So John, I'll let you take over here.
Yeah, well, I think I finally have got my attention span off of pizza, because I really got a good chuckle out of Alf's t-shirt. My grandma hailed from Naples, Italy, and the pizza throwdown that Alf's shirt put out there got me thinking about pizza, but I love that. No, I just quickly want to comment, Alf's views about the Fed not pivoting. I mean, just today, the Fed is trying really hard to say, hey, listen, folks, you're not listening to us. Just today, Esther George was out there basically saying, we're not going to be able to bring down inflation without a recession, almost certainly. Mary Daly was out there, pausing is not on the table, we want to see the economy slow before we slow the pace of raises. So this idea of an imminent pivot, I think the Fed is trying very hard to say, don't count on it. Don't be calling our bluff on that. And perhaps that's why the market's a little weak, on some of those talkbacks. But absolutely, Adam, we've been saying for pretty much all this year, though we think we're in a new phase of a bear market that probably started essentially at the turn of the year. Every prior major bear market that we can think of, at least the ones that are memorable, were oftentimes defined by very sharp rallies, seemingly bright new news that takes the fear away. And we think we're in the middle of one of those right now. We've had 2 or 3 or 4 decidedly pointed versions of that this year, where the market has rallied at separate times very, very swiftly, only to top out at what has been a lower high and take to newer low lows. So we're just a shy way away from the 200-day moving average on the S&P, which probably will provide some overhead resistance. But we do think there's some likely bright spots here, even if we bisect the market into different segments. The broad indices may top out, but there's certain sectors that could continue to go. We've talked very positively about resource stocks and precious metal mining stocks, which seem to be catching a recent bid here. We're too early to call it a reversal in a pretty vicious downtrend. We're looking at different sectors. Energy sector continues to be one that we think has the potential to do well. But also, believe it or not, some banking stocks are looking like they, from a technical standpoint, are firming up. We think there's some pretty strong headwinds with recessionary forces that keeps us a little bit hesitant on those. But we are looking at some areas that could follow through with some of these trends, seasonal trends, some Santa Claus rally cliches, things like that. But we think decidedly this is probably a sellable bear market rally that is getting long in the tooth. We agree with Alf. You get around 4,000 on the S&P, and it's really thin air. And we think the path of least resistance is probably new lower lows that then become an intermediate investment point, probably.
All right. Mike, I'm going to come to you in a minute to talk about gold and the miners because they've been moving a bit recently. But John, just sticking with you for a minute. So you mentioned a couple of things that you're looking at. Alf shared, two interesting opportunities that apparently he's looking at really closely right now. One was the SOFR spreads, calls on the SOFR spreads. And then the other one was shorting the recent surge in home builders. I'm just curious if you have an opinion on either of those two.
Yeah, so certainly the SOFR spread, call spread that Alf talked about speaks to his roots as a fixed income bond manager. It's a pretty esoteric overnight LIBOR derivative rate that most everyday people wouldn't play in, and even our professional money management wouldn't probably take that tack. But I think the takeaway of that trade was essentially a long position in longer term bonds. Basically a yields coming off kind of trade on the long end of the curve. We have talked about ourselves how we have felt the longer term U.S. Treasury bonds have sold off probably more than they should have, and are due for a bounce. We have seen a pretty notable bounce off their recent lows over the last couple of weeks, and some decent follow through on that. So that may be, in fact, that playing out. He also talked about
sorry, real quick before you switch off of that, I do just want to note on the day that we're talking, TLT, which has been a vehicle we've talked about a lot in this program, as a measure of the long U.S. Treasury trade. It has been sold hard this year, got into the low 90s, but it, for the first time since hitting its low, has cracked above 100 here. So, who knows if it's going to go higher, but I'm just noting the milestone.
Yeah, and that move today is because longer term yields are coming off pretty strongly here today. The inversion of the yield curve has gotten more pronounced today. When I say that, I mean the short end of the curve, 1 to 2 years out, or even a handful of months to 2 years out, has stayed very high, but the long end of the curve has come down. 10-year yields have dropped 28 basis points today, 0.28%. That's a big move in a single day. 30 basis points on the 30-year bond. These are pretty big moves that are coming off, sequential pretty big moves down on yields. So right now, I think today the inversion between the 2-year T-note and the 10-year Treasury bond got to be the greatest, meaning the 10-year rate was about, I think, 63 basis points when I looked, below the 2-year T-note. So lower the longer you went out. That's the worst inversion since 1981, I believe. And typically inversions, like what you talked about with Alf, are very ominous signs in terms of economic situation, recession, pricing in recession. And in fact, even the inflation picture, while it's been stubbornly high, it's come off a little bit, and the market rallied at the last, whiff of a slightly better than expected inflation report. If you look at the break-even yields between straight treasuries and treasury inflation protected securities, that's pricing in longer-term inflation out, say over 5 years, closer to the 2.5, 2.7% range. So that's quite a bit of coming off of the recent inflation trend. So there probably is some merit that inflation is going to be coming down pretty hard, but that's likely going to be not because the Fed has done anything, but because we've gone into a recession, a pretty deep recession.
All right, great. And I think I interrupted you when you were going to go talk about Alf's second recommendation there.
Yeah, we were looking at home, so we oftentimes look at every sector. We'll look at across the menu of investments, whether you're talking commodities, equities, fixed income. We were doing our weekly deep dive investment committee review yesterday, and the home builders came up on our technical charts and looked like a very non-convincing chart, looked like a shorting opportunity, frankly. So Alf's instinct there, we think it probably is a correct one. A lot of pain in the housing market that is yet to play out, in our opinion. It has frozen, as Alf referred to. That's probably a fair description in terms of the level of activity. It hasn't broken yet. It's not a crisis yet that the Fed will come to the rescue, but we think there's still quite a bit of pain in the housing market and home building stocks to be priced in.
All right. I want to ask you a question about just New Harbor's approach to shorting in just a second. Before I do, though, I'm going to put up a chart here that I meant to ask Alf about and just didn't have time to. And John, I know you haven't seen it, but I'm going to describe it here as I show it to folks. It is a chart showing the relative pricing of puts and calls. And it's basically showing that the last time that equity puts were this cheap versus calls was March 2020. And what's so interesting is for much of the past year, puts were more expensive than calls as people were getting more bearish. But all of a sudden that has really swung. And if you look at this chart here, you can see, there's only 2 times in this data set, which goes back to November of 2017, where puts have been this cheap relative to calls. And that was right around February and March 2020. So they're saying that puts are 2 sigma cheaper versus calls right now, which, love to get your reaction to, John, but to me that sort of says, hey, this is a time where buying downside insurance is actually, cheaper than it's been. And you were just kind of giving all the reasons why you think this rally may be, petering out or going to roll over at some point here. So love to get your reaction to this as well, just in general. I know you guys aren't big shorters at New Harbor, but what does it take to get you guys to determine to put on a short position in your portfolio?
Yeah, we're not shorters. We don't sell short typically. We don't take net short positions. We use hedging. We use inverse and short type instruments, put options for hedging purposes. Being a short trader is a very, very disciplined and difficult path. Because usually they are painful trades until they pay off all at once. And that path is usually very untenable for most of our clients. And frankly, one need not short to have success. Just simply deferring or defraying or avoiding downside is enough to greatly, kind of tilt the goals of most of our clients, that being, financial security. They're not looking to necessarily win the lottery ticket on a market malady. They're looking to protect their hard-earned assets, and shorting can be for long periods of time, very contrary to that, because it has to pay off all at once. But in terms of the pricing of puts and calls, that speaks to typically a contrarian indicator. Typically, when one is cheap and the other is expensive, it's typically a contrarian indicator that you want to do the opposite. When puts become cheaper on a skew basis, it means that people aren't too fearful, and that's usually when optimism is over excessive and frenzy is to the upside. Usually a pretty good contrary indicator to be a little bit cautious, or if not downright cautious about equities, because the rest of the world is not being so.
Yeah, and that's the main reason I wanted to put it up. But you guys buy a fair amount of puts as a protective measure, and not for nothing, I just want to reiterate for folks that you guys did a phenomenal free webinar earlier this week, walking people through how to use options for defensive hedging strategies. Folks, if you didn't watch that video and would like to see it, just go to wealthion.com/options hedging. But John, as you guys look to protect some of your bigger positions, like your minor positions and whatnot, I'm curious, are you finding it? Like, are you finding that you're able to buy that insurance a little bit more cheaply now than you were earlier in the year?
Not really, and I'd like to see that chart. But just for example, in that presentation we did a few nights ago that you referred to, at the time there was skew. If we looked at the S&P at the time, S&P through an ETF SPY, and this was not investment advice then, nor is it now. The cost of puts was actually a bit skewed to the more expensive side of the call premiums. There's this notion called put call parity, and it's a pretty complicated thing, especially when you get into volatility skew and volatility smiles and things like that. It's a very complicated topic to do proper justice. But at the time, the skew was definitely more towards puts being more rich than call premiums.
Okay, and I should clarify too that this chart that I put up here for Alf's is for I believe SPX calls and puts. Mm-hmm. So obviously the premiums reflect the expectations for the underlying asset class. So maybe the market's got a different expectation for the mining complex than it does for the general S&P. Mm-hmm. All right, well, Mike, look, coming over to you. So we finally have some good news to talk about with the precious metals. They've continued having a pretty good run here right now. So I'm curious if you can just give any context you'd like to give in terms of maybe summarizing the strength that we've seen so far. If you're seeing the resilience here, if you think this is something that's going to fade, and I think just your general expectations about where you guys think the miners and the metals and the companies that mine them are headed from here.
Adam, the chart on gold is still not broken. It's been severely tested, and it's been difficult to be a gold bull during all of these years. But I'm glancing at a monthly chart of gold going back 20 years. Gold hit a swing high in 2011, and then it went through a 9-year consolidation. A giant cup and handle type formation has appeared. And so we hit another swing high back in August of 20, and then a little pullback, and then another spike, creating a double top earlier this year. And then we had 7 straight down months. And looking at this chart, we had a big triangle, a bullish triangle consolidation for a year and a half. And then that 7 straight months down essentially broke that chart pattern. Interestingly enough, though, with the most recent movement up of over $100 per ounce in gold, we've come right back to the breakout point, just about, of that bullish triangle. That price level's at around 1820 or so on gold. Gold's right around 1780 right now. So if we get one good day, we're right back to that bullish trigger point, the apex of that bullish triangle. So the whole 7-month thing could have been a shakeout, could have been a head fake. It seems to happen a lot in this market, not just with gold, but with all kinds of different commodities and stocks. You get a textbook chart formation, like a cup and handle breakout, and then next thing you know, it breaks down and looks like it didn't work. And then after everyone's shaken out, it goes in the original direction. That's what gold looks like right now, particularly if it closes above 1820, only about $40 higher from now. And the strong dollar this year has been a headwind for gold that has recently been alleviated or relieved a little bit. The dollar has come off, and so it's a little bit of a tailwind. Our bullish thesis on gold is not because we think necessarily there's going to be a weaker dollar immediately. In fact, we think it's likely the dollar stays relatively strong for a while. But really, our call on gold is a fundamental and a technical one. Fundamentally, this money printing is going to be found out sooner or later. And again, it's been a really long wait for gold bulls and very frustrating. But when that happens and this chart pattern breaks out to the upside, it looks to us like gold's going to 2,500 or so. And that could be next year if we get some solid catalysts to break us up and out of this pattern. That would likely bring an ETF like GDX, as an example, from its current 28 to maybe somewhere in the 50s. That would be a double from here. So nothing's guaranteed, and this is not direct advice, but we like the miners a lot. We like gold a lot. And as John mentioned a little while ago, we use hedges a lot because nothing is textbook, nothing is black and white. We could easily have a washout in miners if the S&P crashes. So we like to keep some insurance or a floor below those positions. And so we're very bullish, and like usual, take your allocations in mind, keep the percentages within reason. But it's one of the few sectors that we like a whole lot right now.
All right. I was talking to Jim Bianco this week. We did 2 great videos with him. And I talked to him a little bit about gold, and he's quite sanguine on it, and attributed a lot of the strength in the near term to the dollar cooling off. And I think it is worth noting that the dollar really has shown some rare weakness over the past couple of weeks, just given what a massive powerhouse it's been this entire year. Now, maybe this is just a slight retracement in the dollar before it picks up steam again. Who knows? But it's a little bit like just taking the boot off of gold's throat here. And the further that the dollar falls, the better that gold should perform here. So we'll be watching that super closely. There's another thing I hesitate to mention, but I'm just going to mention it just to get the idea out there. The other thing that I spent a lot of time talking with Jim about this week is the implosion of FTX, right, the second largest crypto exchange, and one, just how bananas that story is, but also how impactful it's going to be in terms of the contagion, both within the crypto space and likely outside of it too. And a question that I've sort of been just floating out there of late is, the crypto space has lost a ton of market value over this year before the implosion of FTX, right? But at current valuations, I think it's lost like $2 trillion of market value this year. So by latest count I've seen, there's about maybe 880 billion left in, somewhere around there. And my question is just, will we see any of the capital left in that space migrate over into the precious metals? Because, a lot of people bought cryptos for, the sort of anti-fiat argument, pro-sound money argument. And for a lot of investors that got in the past couple of years, it hasn't worked out very well for them, given how violent the price declines this year have been. And so, look, I get the argument that they're younger, they've got a different mindset, whatnot. But part of me is thinking, well, if you got in there for those reasons, and you're thinking, wow, maybe I want to move my capital somewhere, where it's not getting as badly beaten up, but I still have those same values. Maybe I might want to park some of those in the original anti-fiat, asset, right? There's been a huge debate online. A lot of people thinking, no way, it'll never happen. They just think differently. I just kind of think, man, whatever your philosophy, at some point, if your losses are big enough, it might force you just to start looking around for other alternatives. And there are a lot of people out there that do own both cryptos or, Bitcoins and gold. Why would you take an all or nothing approach, especially if you've been sitting on some of the losses that folks have there? And look, folks, before anyone jumps down my throat, I understand there's not 880 billion of real physical, capital lying there in the crypto space. There's a lot of, still fluffed up valuations there. But I could make an argument that a couple of tens of billions, could shuffle out of there over into the gold market, and that would make a big difference, or silver market even more. So guys, what do you think? I'll start with you, Mike, let you then answer John.
It's really hard to say for sure, obviously, but it makes sense. Some theorize that the crypto boom sucked a lot of capital out of gold and silver, and by extension, the miners. I think that's probably true. Everything got caught up in the everything bubble. And crypto was the new godsend and the replacement, and gold and silver was old man's gold, and crypto was the young person's gold. Well, at the moment it seems like maybe that was misplaced faith, and I don't know about the capital coming out of crypto and going into gold. Some of that capital has just been lost, and because there's been some big drops and some big gaps down, and when that happens, that capital just disappears. It's not a smooth transfer out of one market.
Yeah, I actually did a video on this. Sorry to interrupt. I did a video on this that I'll try to find, but it's called How Capital Goes to Money Heaven. And I specifically actually was talking about it during one of Bitcoin's downdrafts. It's like almost a year and a half ago or so, but it makes that point pretty succinctly. If folks are interested in that, I'll put up a link to the video right here. Sorry, Mike, continue.
So the blockchain is brilliant. The blockchain is probably here to stay. Who knows what token is the one that will do the best? I mean, certainly Bitcoin has been the leader, but it got caught up in the everything bubble. Just like I said, just like housing and meme stocks and collectibles and the S&P 500 and everything else. The only thing that was really left out that I can see on my screen out of the major investment categories was gold and silver and the miners. And so I think it's much more likely if we have an economic crisis or a deep retracement in the market, and particularly if the market doesn't respond positively to an eventual Fed pivot, the market may say, well, this money printing is funny business, and with that, I do think there's going to be a flight to real assets like gold and silver. In other words, I think the gig will be up and found out to some extent. And I think that's the situation in which gold and silver fly. I can't speculate far down the road, many years, about potential central bank digital currencies, although I have no doubt they're probably coming. And it'll be the backbone of that great invention called the blockchain that will be utilized. I don't know which tokens will still exist. But even in that case, I think that gold and silver would really take off. I do think a moment of acknowledgement or justice, if you will, is coming, where the asset class that was kind of poo-pooed for so long will actually have its limelight.
And finally have
That's
its
my
true
opinion.
moment in the sun.
Yeah.
Okay, thanks. All right, well, John, look, I'm going to let you wrap things up here. Feel free to, if you have any comments about what Mike and I were just discussing about the potential move of any capital from crypto to precious metals, certainly chime in with it. But we are going to be having Thanksgiving here in the US next week. That means we're getting to the end of October. That means the end of the year is coming up fast. If there's any sort of commentary you have for folks about just things they should be thinking about as the end of year approaches from a financial planning standpoint, just let us know.
Yeah, I don't have much to add to the crypto versus gold conversation you guys just had. The only thing I would add is there was a decided speculative fervor around cryptocurrencies that got beyond the, hey, this is sound money. When you start seeing hyped videos involving celebrities and famous people with notions of rocket ships going to the moon, that is a problem, right? That is emblematic of speculative fervor, which maybe in the moment it's hard to see for what it is, but in hindsight, you can certainly understand what it is and what it represented. Not unlike a handful of years ago when gold peaked out and people were literally having home-based businesses, gold parties, let my friend come to your house and bring all your friends with their, gold jewelry they don't like and come, gold prices are going high, they're going higher, sell your gold, right?
Right. Remember all the cash for gold commercials?
Yeah, but even worse, it got into living rooms. I mean, forget the Hannah Bowden trunk shows that, or other things. This was bring your gold. It's a opportunity to have some wine and cash in your gold for awesome prices. And, that was in its own way kind of emblematic of speculative fervor reflected in the prices. You look at some of the videos coming out of this FTX implosion, utterly jaw-dropping. Seeing the CEO on a video, I don't know if it was meant to be a publicly aired video, but basically talking about like, hey, we started off on this idea of yield farming, and it was crazy enough to begin with, but then it got to the point where we were just focusing on the stupidest idea that we could yield farm against, and that's what my main activity was every day as the CEO. That is like utterly jaw-dropping. So to the extent that there is this concept of sound money that flows from crypto into gold, yeah, there's probably part of it, but there's a whole other probably multiple fold element of just speculative craziness that I think is just coming out of the market right now.
Right. And just to note that, folks, if you wanted to see the clip that John's referring to, just go to my Twitter feed. It's at Menlo Bear. He's talking about a clip of the CEO of Alameda Research, the 28-year-old CEO of Alameda Research, who was initially hired as the senior trader, then became the CEO. And when she was hired, actually admitted to having very little trading background. But of course, she was put in charge of a group of 20-year-olds managing eventually over 10 billion in capital and doing all sorts of things that have blown up. And you watch that video and you think, my God, how did anybody get to know the CEO, who could speak like this and allow them the responsibility that they had? It really is mind blowing, as John said.
Yeah.
Right,
you asked about year-end stuff, Adam.
Yeah.
This time of year, it's always helpful to start thinking about tax-related things, unrealized capital loss harvesting to offset gains. Looking ahead to maybe preemptively taking some distributions from IRAs at what might be an advantageous tax rate now versus what maybe the future might hold. These are all sound and sensible things that we talk with clients about all the time, and it's usually year end where this has the most immediacy and applicability to folks' mindsets.
Okay, and just to sort of remind folks of what we're talking about here. So when John talks about sort of tax loss harvesting, particularly relevant in a year like this one, where there's a lot of people that probably are sitting on losses from assets they bought, end of last year, beginning of this year. And it's basically, selectively looking to say, hey, should I sell these, take the losses, and reinvest the proceeds. And what I'm doing there is I'm locking in a loss, but it's a capital loss that I can then use in the future to offset capital gains. And we won't go too much in the weeds on this right now, John, but you're not allowed to buy back the same security you sell or one that's materially similar within 30 days, or else that would trigger what's called a wash sale. And you wouldn't get these tax benefits that we're talking about. But if you wait, just a month, you can even go back into these same positions if you want to, and ride them back up. And of course, you can in the in between. You don't just have to sit in cash in the proceeds. You could actually put them into something that's similar. Like, let's say you have a gold miner that's lost a lot of money. You could sell that, lock in that capital loss. You could then put your proceeds into GDX. And sit in GDX for the next month, just in case the mining complex really takes off. Well, okay, at least you're capturing the beta. And after your 30-day expiration window, if you still think, I think that miner I was in still has some good prospects, well, you can move the capital back in and then be positioned to catch any potential future upside that's there. Or, you could take your capital and say, hey, maybe that wasn't the best miner. Maybe there's a better investment or set of investments to diversify this money into, and go off to the races there too. So, all right, John, and I'm sure this is an obvious yes, but these are considerations that you guys can help people with, right? They can call you up, they can share their potential situation. You guys can give them advice on what you think they can do from these sort of end of year standpoints that you're talking about.
Yeah, absolutely. We're not tax advisors, we're not CPAs, but we're very in tune with the tax aspects of investing, and those kinds of things are pretty simple things to talk about. To the extent they get more complicated, we oftentimes can and do talk with clients' tax advisors, their CPAs, if they got more complicated situations involving businesses or rental properties that aren't so cut and dried. But yeah, these are all things that this time of year are very common for us to talk about.
All right, great, guys. Well, thanks so much for joining me for another week. I'm just going to mention a couple free resources here, and then I'll let you guys have the very last word. So just a reminder, if you haven't watched the free webinar on options hedging that we talked about earlier, but if that's a topic that interests you, just go to wealthion.com/options hedging. You can watch the replay of that event there, totally free. Very useful, by the way. Just a reminder too that we're continuing our process of having me write up my key takeaways from our major interviews. So if you want to get my notes again for free from this discussion with Alf, just go to wealthion.com/Adams notes and you can read them there. As we just were talking about here with John, if you are looking for help, especially with maybe answering, some of these year-end questions about steps that you might want to think about taking before January 1st comes up, feel free to schedule a free consultation with one of the financial advisors that Wealthion endorses, perhaps even Mike and John themselves and their team at New Harbor. To do that, just go to wealthion.com, fill out the short form there, only takes you a couple of seconds. And then last, if you've enjoyed this interview with Alf, would love to see him back on the program again, but other great minds like him as well, please support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, guys, we got Thanksgiving coming up next week. I'll let you guys end with any words of gratitude or counsel you have for the audience here. John, why don't we start with you, then we'll punt to you, Mike.
Gratitude galore for the time to spend with viewers here. We know you have a big viewing audience, Adam. We really appreciate being able to be heard and listen. We get lots of fine compliments back, both from clients and non-clients alike. So that means a lot. We hope our time here with you, which is a great service that you provide, Adam, to your viewers, which is growing by the day, thankfully and deservedly. Great time to just express gratitude and thanks for the opportunity.
All right, Mike.
Just want to say thank you, Adam, and thank you to the Wealthion channel for giving us this great platform and the opportunity to speak every week. And thank you for your viewers for tuning in every week. And there's lots of people that say they love this program. They like watching you, Adam, and all your great guests, and they like following us, believe it or not, as well. And we're happy to broadcast everything that we do, or most of what we do, every week. And we're pretty transparent about that. Right now, we're back up to 50% or so cash equivalents. We're really defensive. We caution viewers to be the same. We think we're entering the near the end of a bear market rally here. So until next week, when we talk again, I just want to say thank you, everyone. Have a great Thanksgiving.
All right. Well, whatever happens next week, we will be here to deconstruct it for folks next week as best we can in the midst of the holidays. John and Mike, thank you guys for being such a big part of this channel and for hanging with me week after week here and bringing your expertise. Look forward to seeing you guys next week. Everybody else, thanks so much for watching. If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.